The Omicron variant is out, and Pfizer and Moderna are adapting. We'll give you an update on both companies and their stocks. We'll show you the financials using our software. We'll use our stock analyzer tool to show you what you should be paying for these companies moving forward. And if you want to trade either of these companies, Mo will show you all the charts and trends so you can make money on the movement. But first, why should you watch this video? I bring your questions about this new COVID variant and both of these pharmaceutical companies to a couple guys who own and operate over $100 million in real estate, multiple businesses upstairs, and stocks, and they'll give you a mindset and a pathway to invest. Paul, what do you think is going on out there with this new variant, and how will these companies adapt to it?
Thank you, Seth. First off, follow us on Instagram, Everything Money Investing. It's our new Instagram account. And follow Seth and Mo and I personally. I just hit 5,000 Instagram followers.
Really?
So I'm basically like the most popular person in the world.
I knew that would happen at some point. Keep going.
It only took me buying 8,000 of them. So, see what I did there? Yeah. So guys, Pfizer and Moderna. Now this new variant of
Omicron.
Omicron or whatever it's called. So,
should I say it?
Do not say it. This is now, so I saw the Moderna, Moderna is down a lot today, isn't it?
Yes.
What's Moderna at?
It was,
it's down it's 4.3%. I thought it was more than that.
6.7% now.
Oh, okay. Anyways, their CEO came out and said something like, we don't know if our vaccines will fight this new variant. Mm-hmm. First off, that makes sense to me. It's like, okay, well, we don't know. There are new variants always coming out. I mean, I'm not a scientist by any means, but that makes sense to me. But it's also why I want to tell you guys, just be careful when you're investing in companies for one specific reason. If it's for just one product line, this is why I like to have a diverse product line. This is why I haven't bought into the hype when it comes to these companies. So let's look at Moderna real quick. Because I believe Moderna is like one of the most overpriced companies like of all time here, if I remember correctly. It's a $140 billion company. Actually, the 1 year PE is only 20, but it doesn't even have a 5-year PE because it doesn't make money over the last 5 years. So I'm just going to skip real quick. First off, let's look at the 5-year chart for Moderna. In 2020, beginning of 2020, before COVID, it was an $18 stock.
Jeez.
Now it's $350.
Wow.
Seth, didn't you tell me to buy Moderna in January of 2020?
I don't recall that, Paul, no.
Okay. But look at their revenue in the last 5 years. Last 4 years, 191 million, 81 million, 246, 11.8 billion.
Oh my gosh.
I mean, this is crazy. Look at the profit.
Good for them, right?
Loss. Seven. Wait a second. How do they do $7 billion in profit on $11 billion in revenue?
They're awesome, Paul. Duh.
We must have gotten something from the government.
Oh, yeah.
Income from, what?
Yeah, they've gotten a lot of money from the government. I think the grant number was $300 million in the first 2 quarters of this year.
Okay, but still, it doesn't account for why it's such a big jump.
In what?
Where is the big? I want to see where they must have gotten some big check from the government. Interesting. Shares outstanding, not as bad as I would have thought. They had 320 million shares 4 years ago. Now they have 400 million. I would have thought way worse. So let's talk about from a 500-foot view, because really there's not a lot of data. I like to look at companies with a long history of data. And the reason, and this works for me. I have this conversation all the time with people in our chats, all of our subscribers. Paul, why do you ignore these companies? It just what works for me. Some people are great about analyzing smaller companies that don't have good track records. I like bigger companies with track records. They're just selling for cheaper prices. That's what I like to do. It's boring, but I don't need to beat the market by 6, 7, 8% a year. If I just beat by 2 or 3% a year and do options on top of that, I will have more money than I ever need. So why do I sit there and have to labor myself through so much? What does Moderna have besides these vaccines? It's nothing, right?
Yeah, they have 3 phase 3 products in the pipeline, but not a ton of products.
So they were very revolutionary before COVID because they started using this mRNA mechanism for a lot of drugs. So that's kind of why you heard their name before, and now it's obviously COVID.
So Moderna's market cap is 141 billion. Now let's go to Pfizer. What's Pfizer's?
A company that has been
300 billion. So call it double. But what's Pfizer's revenue? 69 billion. What's Moderna's? $11 billion on one product.
And Pfizer's
A diverse company with how many phase 1, 2, 3 things coming into play.
So what
It's
you're
got
saying
cash
is-
flow out the butthole.
And
So you're saying
they've been around for a very long
5x
time.
on revenue.
Not only that, Seth, they do more in free cash flow in the last 5 years than Moderna does every year in revenue.
Revenue, yeah.
So I'm looking at going, would I rather pay $300 billion for Pfizer than pay $140 billion for Moderna? If those are like gun to my head, you pick one, I'm picking Pfizer.
Of course.
More diverse revenue, more free cash flow, a lower 5-year PE. We have a 5-year PE of 19 here. So let's do a Pfizer analysis real quick. Let's use our 8-pillar system to the Pfizer analysis.
Sure, go ahead.
So 5-year, the first thing we want to do for Pfizer is look at the 5-year PE. We want it under 22.5. It is 19.3. That's a check mark. Pillar number 2, we want the 5-year return on invested capital greater than 9%. It is 12.1. Another check mark.
Nice.
2 for 2 so far.
Dividend, Paul.
Guys, huge dividend. 2.9%, pays out 8.65. Because dividends are based on free cash flow, we look above it. The average 5 year is $16 billion. Last year they did $29 billion in free cash flow. They can easily afford this $8.65 billion dividend. So that's awesome. Pillar number 3, we want,
Revenue growth over the past 5 years. Income statement, yeah.
we go to our trusty exclusive software. We go to the income statement. 5 years ago, $52.5 billion. Last year, $69 billion. But look at this. In 2020, they did 34. Oh, this is weird. Oh, this is weird. Okay, I'm a little apprehensive now. Guys, I don't like this. Massive fall, massive jump. Did they sell off divisions? Let's go to the cash flow statement and see where acquisitions. Oh no, they haven't had acquisitions in 2017. So was this just because of COVID that everything else, like they stopped? I mean, what happened here?
I don't think that they have 94 drugs in their pipeline, 29 in phase 3. I don't think that they would just stop everything to go to COVID. You know what I mean?
Well, it's not even that. People just stopped paying them. Their revenue doubled in 1 year. But then in the previous years, they were declining from revenue. This is a red flag to me. Look at the revenue of the previous 10 years. Very stagnant, and then plummeted, and then jumped back up. So make sure, as part of your due diligence, when you're doing the 10K and reading other articles,
This is where you go to the risk factors in the 10K.
figure out what happened here. What's happened in the last 4 years? 53, 40, 34, 69. This is very troubling for me. Okay, pillar number 4, net income. So we scroll down our income statement from our exclusive software. We had 9.8 billion to 19.89. Check mark there. Pillar number 5, shares outstanding. We want shares outstanding going down because we don't want to be diluted as owners. 5 years ago, 5.95. Last year, 5.61. Another check mark. Wow. I think we're on the check mark train here, aren't we, Seth?
I'm looking up risk factors right now. Keep
Oh,
going.
you are?
Yeah.
Great.
Look
Pillar
at the
number
top 5 or
6.
6.
Pardon me?
I'm just telling Seth, look at the top 5 or 6.
So pillar number 6 is we want the long-term liabilities. We're going to look at them and see if they're reasonable. So what do? We go to our main page of our exclusive software. We go get the 5-year average free cash flow, $16 billion. We multiply it by 5. That's $80 billion. We want the long-term liabilities to be under $80 billion. So scroll up to the top, go to the balance sheet of our software, scroll all the way to the bottom. Total long-term liabilities, $61 billion. So check mark there. So far, we are 6 for 6. Pillars number 7 and 8 have to do with free cash flow. So we go to the cash flow statement. The first one is we want free cash flow growing. What is free cash flow? Cash from operations less your capital expenditures. You can do one of 5 things with it. Pay down debt, buy back shares, pay dividends, and, make acquisitions, or invest back in yourself. Okay? So I've added this line to the software to make the math easy for you. Free cash flow line, cash from operations less your capital expenditures, 13.5 to 29 billion, check mark there. All right, so the final pillar, we take our 5-year average free cash flow, 16 billion. We multiply it by 20 for a multiple of free cash flow. This is a starting point for the company. That's $320 billion versus the market cap of 300 billion. That is a check mark. That means we're willing to pay 320 versus the market cap of 300 billion. That's a check mark there. I think this is an all 8-pillar stock. Let's go to our 8 pillars tab because we do all the math for you. 8 pillars tab, boom, all 8 check marks. So the question becomes, guys, does this mean we buy it immediately? No. There are concerns here. Have we figured out anything on the revenue side? It might take some more due diligence, guys. You might have to read more articles, listen to earnings calls, figure out why the revenue fell so much, then bounce right back up.
Yep.
But that is something you have to understand. Because if you don't understand how you're going to lose money, you won't understand how to make money. So, and vice versa. So, our final step, we're going to use the stock analyzer tool. This stock analyzer tool has been one of the most successful things exclusive to our software. The future is unknown, and all investments are the present value of all future cash flow. So you have to make assumptions on the future. Those assumptions are what drive the results, right? I can make assumptions of 100% revenue growth. Are they reasonable? No. So I have to sit here and use our assumptions. I'm going to do a 10-year analysis on Pfizer. So guys, look at the numbers here. In the last 10 years, they have 2.9% revenue growth, and last year they did 102% revenue growth. So, Uncle Mo.
So that 2.9 includes adding 103%.
Oh yeah, it does.
Correct.
So,
I mean, the revenue growth is up. It was like 53 billion last year, so
Yeah.
I mean, 10 years ago.
1, 2, 3.
Okay, 1, 2, 3.
Yeah.
Mo, their risk factors is an incredibly confusing section.
Is it?
Paragraphs and paragraphs about consumer health, joint care, pricing and reimbursement, generic competition.
So here's what I'll
it's
say
a
to that,
lot.
Seth.
Yeah.
This is what I'll say to that. After the stock analyzer tool, you're going to hear about the software. This is why you should join it, because we have over 6,000 people in our exclusive software that you can talk to about all these risk factors and talk to you about. There's a biotech chat just to talk about biotech. This is exactly why you need that community of people to talk to about it.
Yeah.
So back to the stock analyzer tool. Profit margin.
27, 29, 31.
27, 29, 31. Free cash flow margin. How about the same number? Yep. PE.
14.
Too high.
I'm going between 14, 16, 18, and 12, 14, 16.
I would do 12, 14, 16.
And I'm
Here's
doing
why.
that because of the size, Seth.
Yeah, because of the size. And same with free cash flow. I like to have the same multiples because over long periods of time, earnings and free cash flow should be pretty similar. And finally, desired return. Guys, I always put 12.5%. It provides an ample margin of safety. And if you can invest in an ETF and get 9 or 10% with no work, in order to do work and get some return, give yourself some reason to do it. We hit the analyze button. We scroll to the bottom. Oh boy. A low of 32, a high of 48 with 40 in the middle. The company is currently at $54. So it's not a buy in any of these metrics. Now, do you believe these metrics? You might be like, no, the revenue growth is going to be a lot higher. Great, let's go to higher revenue growth. 4, 6, and 8%. Watch how much that changes it. Okay, it's still not in the middle range yet, pretty close, but the high it's working at. So guys, again, everything's about your assumptions. Make whatever assumptions you want. Our goal is to make conservative assumptions and find companies that are selling lower than their conservative assumptions. So our goal is to find companies that are selling for lower than our low assumptions. Okay, that usually happens when there's negativity around the news, like something like Carnival Cruise Line. It was at single-digit prices when the world was thought to be shutting down and never going to open back up again. That's when you want to find these things. So that's where we stand here on Pfizer in terms of the analysis.
If looking at these numbers resonates with you, Paul will tell us right now how to get this software. You can do it right now. Go ahead, Paul.
All right, thanks, Seth. So guys, we created the software because our users kept requesting, how do we do our own research without waiting for you to make your own videos? So we spent lots of money, created the software. You get everything you already saw in the video. You get all of this content right here, which includes 30 years of financial data, access to Seth Mo and I. You get it all on your mobile phone. This entire website, everything you've seen on your mobile phone. You get the stock analyzer tool. You get real estate calculator, retirement calculator, all the extra additions. You get our 8-pillar portfolio, exclusive daily content, 2 or 3 videos a day from Seth Mo and I on separate topics. But most importantly, guys, you get access to over 6,000 people are current active users of our software. They're in a chat that's very organized with multiple rooms about different topics. You can talk to them about all your investment ideas, tell them your ideas. They give you feedback. You have actual discussions because most of the people are like you out there who didn't have others to talk to about investing. Now you do. This is wonderful. It's only 90 cents per day. Less than a cup of coffee, guys. 90 cents a day. If you can increase your returns by 1 or 2% a year, or decrease your losses by 1 or 2% a year, this will lead to hundreds of thousands, if not millions of dollars in extra wealth when you retire. 90 cents a day, guys. 2 ways to sign up. Everythingmoney.com or Patreon. The benefit of everythingmoney.com is You get no sales tax charged to you yet because we're not big enough. So sign up. You get access within minutes, 90 cents per day.
If you're looking to trade these two companies at a quicker pace, you can head over to Bid and Ask Nation. You can join Mo in our top tier of traders, and he will guide you through the process. Mo, look at that up and down. What's going on over there? Is that Pfizer right there?
This is Pfizer right here. So when you get a company like Pfizer, which is very news-driven at this moment in time, be careful with it from a long-term perspective. You can absolutely trade it, and you can see that you could have made a very nice short coming down here, and you could have made a very nice long position coming up. But now that we're getting into these all-time highs, I probably wouldn't even play with this until this long-term stochastic starts rolling down and moving into a downtrend. So what would I do instead? I would come over here to a daily chart, and this is what I would do. I would go ahead and we're above all 4 major moving averages. The likelihood of it coming back down to the major moving averages is higher than normal. So let's wait for more selling volume to come in, let this thing turn into a downtrend, and then start making engulfing candlesticks. And you'll notice right here, there's a little gap that needs to be filled. So that's going to happen. This thing is going to come down to the 25-day moving average. I would throw this on a watch list, try to short it over a few-day period. But you could also come over here and do a 15-minute chart trade, and yesterday would have been a beautiful short. Yesterday, bad news came out. You could have shorted this literally the entire day from about 11 a.m. through the close of the market, and you would have caught this entire rundown by just using the rules that I teach you. So if you want to learn those rules, come and join me in the Bid and Ask Nation. You'll get the Trading 101 series, which is an explanation of series of videos which gives you all of those rules that you need to be successful. The Employed Trader series, which is 6 stocks that we go through every single day, and I teach you about it from a long-term and a swing trading perspective. Exclusive monthly seminars, which one I'm doing this coming Saturday at 9:30 in the morning, and a Bid and Ask Discord community of 900 plus people that all want to make gains on a chart just like you.
That's our take on these two companies. Stay tuned. We'll update you and always give you our thoughts. Fondle thumbs up. Join us in the next video. We'll see you next time. Thanks.